Hello everyone, welcome to my second money-making video. My first video was actually how to make money on your mobile device in about 5 or 10 minutes. Now I'm going to move something to more of an intermediate level. In this video, I'm going to be going over how to make passive income from stocks, or in some people's cases, mutual funds, and I'm going to explain the difference between the two. Again, just to gloss over what passive income is, it's making money while you don't actually have to physically do something or be somewhere, which is amazing because it makes you money in some cases while you sleep. Some people will wonder, what's the difference between a stock and a mutual fund? Well, the difference is a stock is one company and a mutual fund is normally a collective amount of stocks from different companies bundled under one roof, one umbrella, you could say. There are advantages and disadvantages to each mutual fund and stock. A stock is you will be paid normally a dividend. Now this can be done once a year, twice a year, 4 times a year, but you will get a little bit of money or more stock bought through that dividend. The disadvantage about a stock is you actually have to buy it. So when you do purchase this stock or whatever it is, you do need to pay a transfer fee, a buying fee or a selling fee. This is great if you want to buy a stock and hold it for a long period of time. With a mutual fund, this is a collective amount of stock put in one basket, you could say. But normally there is a monthly service charge, or an expense charge, I should say. Normally when you buy a mutual fund or some mutual funds, you have to keep it in that account for 30 days in order for the company or whoever's running the mutual fund to be able to get their share of the expense, because they want to make money at the end of the day, right? They are like us, they're just a corporate company. Now that I've briefly glossed over what a mutual fund is versus stock, which one's right for you? Now, if you only have $100 to invest, I would say mutual fund, because you're going to get zapped in a transit fee, the buying fee and selling fee if you only buy $100 worth. It's pretty much not even worth it. So in that case, you'd be better off with a mutual fund and slowly building that up until you have enough to actually buy a stock that you want. Now, there are tons of types of mutual funds. There are safer ones, such as bank stocks. These are collective banks put in one basket, just you're hedging your bet and buying a little bit of each. There's also riskier ones, such as REITs. These are ones that are real estate investment type stock. These are very risky. I would recommend shying away from them, even though they historically can pay you the highest dividends, but I wouldn't really recommend that. I would say once you get to about $1,000 or even $2,000, start thinking of a good place to put that money as far as buying a stock. One great way to learn which stocks you should maybe be looking at is looking at what mutual funds you put your money in originally. Normally, the top 10 stocks in a mutual fund are the best performing, historically anyways. Once you figure out which companies you like, you can do your research as far as how they've been performing and how does it look in the future if you were to buy the stock. Now, I can go into the appreciation of the stock, but for this lesson, we're only going into dividends. Once you've decided on a company that you're comfortable with, then you would actually buy that stock and hold on to it for whatever time you're looking for, whether it be a year, 5 years, 10 years, whatever the case is. I would highly recommend taking a look at bank stocks. Now, being a Canadian, I am a little partial to Canadian banks being a little bit safer than the American banks just based off of the recent recession or semi-recent recession. Financially, banks are extremely strong and they make billions of dollars every year. It's ridiculous how much of a money-making company banks are. Go figure, right? So if you were to purchase a bank stock per se, and I'm just going to throw very general numbers out there, if you were to get 0.5%, 1% back every 90 days in the form of a dividend, you're getting a check cut right from the bank, put back in your pocket just for having money invested in them. So this goes back to that whole concept. You got to have money to make money. Well, in investing, it's definitely the case. And if you have a little bit of money, it can keep growing and growing into more money. One concept that is very popular with dividend investors is what's called the drip. No, I'm not talking about the type of coffee. I'm talking about the concept of the dividends that are paid out to you being reinvested back by buying more stock or mutual funds, depending on your case. Long term, this works fantastic for stocks because the drip does not cause you to have to pay any fees to get that little more of stock. So realistically, your portfolio grows every 90 days. If all goes well, of course. Now, if you're a long-term investor like me, this is fantastic for you. But if you're the type of person that would like to actually have a little bit of money on the side, collecting your dividends is also a good thing as well. By letting your dividends pool in your investing account, you can then have a little purse that grows and grows and grows so you can buy more stock. Or if you're in debt, you can take that and put it towards either your credit card, if you have a high car loan, student debts that are way out of control, whatever the case may be. But I highly recommend not doing that unless it's credit card debt. I know a lot of younger people at this point are going to be thinking, yeah, great, who has $1,000 or $2,000? Well, like I said, if you can slowly scrounge this up and plant that seed, 5, 10, 20, 30 years from now, this is going to grow into a massive tree if you let it. The one advantage I would say that younger people have over middle-aged or older people, people with money, is that we have time to let the compound interest accumulate, let the drip go bigger and bigger. The sooner you can plant that seed, the easier it is going to be to grow that money further down the road. I would personally love to see everyone retire early, live off of dividends, and have a comfortable, fulfilling life doing stuff they would like to do, and not necessarily being a slave to their job. Alright, that about wraps it up. This is just a quick lesson for anybody out there who's maybe in college or a young professional who has had no exposure to any financial teachings. Now, I'm not saying I know everything out there, but if I were to go back 10 years ago and tell myself something, this is exactly what I'd be telling myself. Invest, be patient, and be smart with your money. Anyways, guys, if you haven't clicked the like button yet, please do so. If you haven't subscribed, please subscribe for more. I plan on doing a video once a week, hopefully, with money-making ideas or anything that I feel the creative urge to do. Hope everyone's having a fantastic day, and I'll see you guys next time.